The wealthmanagement.com Advisor Innovations podcast is sponsored by LPL. As financial advice continues to evolve, LPL is at the forefront. Whether it's growing your RIA or building an independent practice, advisors can pick the business model, services, technology, and product mix that best meets their clients' needs. As a top wealth management firm, 100% dedicated to advisor success, LPL looks forward to learning how they can help you build your tomorrow today. For information and show notes, go visit lpl.com/advisor innovation. Hello, everyone. Thanks for joining us. This is the Advisor Innovations Podcast. I'm David Armstrong. As you know, this is the podcast which just simply gives me an excuse to talk to folks who are pushing the business of financial advice into new and interesting areas. And today, I'm thrilled to be joined by Jason Wenk, the founder of Altruist. Jason, thanks very much for joining us.
My pleasure, and great to talk to you again.
Good to talk to you too. We had a good conversation at a recent conference, and I'm happy to continue it. Jason, as most of the listeners here will know, is the founder of the newest custodian on the block, Altruist. Many people have heard of it. About a year ago, got the Series B round of funding, $50 million. Looks like it's here to stay, a success story. Also the founder of Formula Folios before that, sold to Brookstone Capital, I think in 2020. And we'll get a little bit into his history. But first, Jason, before we do this, bring me back to the idea, the germ of the idea for Altruist. Where was it born? Why was it born? What need did you see? What was going on in the industry where you said we need something like this?
Sure. So I started my first RIA in 2004. And at that time, I had basically I had no clients. I was a brand new startup firm. And back then the RIA space was very small. I mean, I don't know what the total count was of firms, but I would, guess it was maybe a few thousand. And even the majority of the firms were probably asset managers. They weren't really like wealth managers or financial planners like so many of them are today. And the journey started with finding a custodian. So I called a couple of the really big firms at the time. I couldn't even get them to give me a call back. I didn't have enough assets. And there was one firm that was willing to sort of take on smaller firms that also had some brand recognition, at least to me. And that was at the time, TD Waterhouse, later became known as TD Ameritrade. Mm-hmm. And so super grateful, that they were around and they were willing to take startups that didn't have any clients or assets. And in that kind of process, I remember one of the strangest things was talking to the sales rep. And in my mind, I thought, okay, once you have a custodian, you're pretty much good to go. Maybe you need a CRM and some planning software, but like the custodian should be able to do all the other stuff, like it should be pretty easy to manage the accounts. Once I open them there, it should be pretty easy to do, to build my fees. They probably even do it for me was my assumption, right? But what I learned when I got going was that actually not much could be done directly at the custodian. You had to have, if you wanted an elegant place for your clients to see consolidated access of their accounts and performance reports, you had to have a portfolio management system that offered a client portal. And if you wanted to do fee billing, like you'd have to kind of create your fee billing schedule and have them, sort of imported into the custodian to debit the accounts. At the time, they didn't have iRebail. So if you wanted to do trading, again, you either had to have an external trading solution or you were managing these accounts onesie, twosie. And I remember I kind of half joked at the time, to the sales rep, and I was like, guys, seems like all this should just be built in. I mean, why wouldn't you do that? And their response was, well, nobody wants that. They want to be able to build the best of breed tech stack, where you can pick all your favorite vendors for those things, versus us trying to do it for you. And that was just sort of like the answer that I accepted as truth. I still always thought in my back of my mind, I was like, gosh, it seems like there's a really big opportunity for someone just to make this more turnkey. And interestingly, part of that's what led me to start my second company, which was, you mentioned Formula Folios, which was a turnkey asset management platform, because I felt like it was so hard actually to work with the custodians that a lot of advisors would rather just use a turnkey platform where someone else essentially assembled the technology, built we had a pretty good set of engineering teams. We built our own proprietary advisor portal, a bunch of tools to automate portfolio management. And it was pretty successful. The TAMP took off and raised a lot of assets really quickly. But what I learned was that at scale, once you start trying to manage 50,000 accounts with multiple custodians, The TAMP doesn't really make anything better. It's just sort of like a Band-Aid, that this sort of like middleware between an advisor and the custodian. And oftentimes, no matter how much technology you built, like you were still at the mercy of your core infrastructure, which was a custodian. In other words, if you wanted to have truly digital account opening, if they didn't support it, you couldn't do it, right? It didn't matter how innovative you wanted to be, that wasn't going to happen. Same with things like money movement and ACATs and trading, like you were always at the mercy of that core infrastructure. So I like to say that the original idea was planted in like 2004. Many, many years ago. I finally got fed up with it because once you start building large multi-billion-dollar firms that are adding billions of dollars a year and opening tens of thousands of accounts a year, those same problems that you experience as a small firm, they're just 10,000 times bigger, right? They don't necessarily get much better, and your economics, there's a point where you have very diminishing returns in terms of your scale resulting in better economics. And I felt like we were long overdue in our industry to have an actual modern, fully vertically integrated custodian.
Well, what you were envisioning, this is the pre-Veo days, right, of TD Ameritrade, with all the widgets of all the different vendors that you could kind of plug into a tech stack and build yourself, and then advisors, as I understand it, would just then spend the rest of the time complaining about the integration failures, right?
Correct. Yeah, I would say like the things got a little bit better, over time. But yeah, you never, integrations are different than vertical integration, right? So for advisors who don't understand the difference, managing a bunch of external integrations from companies that use different backend technologies, they have different test environments versus production environments, meaning like, when you try to like get the connection to work in a demo environment, might work great. In reality, then in production, it doesn't work great. You have 6 different vendors and 3 of them integrate and 3 of them don't, right? Like all of a sudden, what's the point of the integrations? Vertical integrations where everything just works out of the box. There's no need for external integrations because it's actually natively built into the application. So yeah, we went through that. Obviously, I had about 30 engineers that worked for me at Formula Folios. We worked very closely with companies like TD. We built a really elegant solution, based on what tools were available, but it still left a lot to be desired, in my opinion. So that's partly why I felt compelled to go start a new custodian.
Yeah, there's some confusion about Altruist being a custodian or an introducing custodian. What's the relationship between Altruist and Apex?
So Apex is our clearing and custody vendor. And this is, not dissimilar to, for those who've been in the business for a while, they might know of companies like Trade PMR. Trade PMR uses, I think it's First Clearing, which is a Wells Fargo, subsidiary for their clearing and custody. But I don't think anybody ever refers to Trade PMR as an introducing custodian, right? I think there's, a bit of a difference. But this is really, this is not like a bad thing. It's one of these things where I think as an advisor, you want your clearing firm and your custodian to have scale. You want them to be a larger, stable institution that process millions of transactions, have been around for a long time. So these are reasons why when you're a startup, it makes a lot more sense to partner with an established clearing firm. And if you're a fintech, you basically have 2 options. There's maybe a third option in that department, but it's basically going to either be Apex, Drive Wealth, or a new startup called Embed. Although again, many of these clearing partners, they don't have the tools that advisors would need, right? So they might only support like individual accounts and individual IRAs or something like that. And clearly, as an advisor, your book of business is more complex. Apex they've been around longer, and they have a bit more, account types and security types and abilities to support the complexity of an advisor business.
Yeah. So am I wrong to think of it as sort of, Altruist is kind of like the faucet and the thing that you interact with. Apex is kind of like the pipes way down deep in the ground.
Yeah, and I think we've built a lot of our own pipes too. So there's certain things like, for example, like we built our own order management system from scratch. So we're not relying on someone else to create our bundled orders and send those to market. We're doing those directly. Our rebalancer, we built our rebalancer from scratch. Originally, we used to use Apex's rebalancer, which is again, a helpful way to get started, but eventually you start to build, again, a lot of your own pipes. So certain components, are 100% proprietary, built from scratch by Altruist. And then a lot of the things that are very specific around clearing transactions and the holding, the custody of those transactions are the pipes provided by Apex.
And I think a lot of the commentary around Altruist when it launched was that you can't possibly scale this to the size you need it to be in order for it to be successful. That's not true. What's your argument against?
Well, I think there's an unfortunate part of our industry where, some of the loudest voices don't actually know anything about custody, right? So they have really big opinions on things, but I don't think they actually understand things like startups. They've never done one themselves. They've never built one at scale. They've never raised, $100 million to build a company. They never built a 3 or 4 or 500 person organization. So I don't really listen much. I think I knew, to me, there was never a doubt in my mind. There was never a doubt in any of our investors' minds. There was never a doubt in any of our early founding employees' minds, our board's minds. This was never like we sure hope this works. It was like, well, this will not just work. This will become potentially one of the most transformative companies in the history of our industry, like akin to how Vanguard innovated funds. We think we'll have that same type of innovation on custody clearing, and specifically RIA custody. It's the only business that we're in. And so, I was never surprised that this was going to work. I mean, I've been an entrepreneur for a long time. I always just find it more comical when people say, oh, well, yeah, that won't work. And it's like being said by people who've actually never done anything in their life at scale.
And worth it to note that Vanguard was a participant in the most recent series.
They've actually been an investor since our Series A. So they've been an investor for quite a long time. Bill McNabb, their former chairman and CEO, has also been an investor and has continued to re-up his investments with each subsequent raise. So I think, again, if you're wondering, people who would know, is this going to work? Do I want to be personally involved? Do I want to commit my own personal capital? Do I want to join the board and be active in helping grow this business? If they have high conviction, to me, that's a lot more meaningful than, like some, armchair, whatever analyst who's never been in the space in a meaningful way. So we've got some really super supportive, awesome investors, and it's made it a lot of fun, but also a lot easier, having some of the resources and intelligence, that comes from great people.
Yeah. And speaking of the loud voices, and we'll get off this in a minute and do a deeper dive into your past, but the argument around how custodians should be paid, whether or not they should be paid on the back end by their money management or order flow versus RIAs paying a basis point fee to the custodian. You think that the latter option is not viable?
Correct. Which, if you'd like me to elaborate, I'm happy to. But
please. Why not? I mean, why wouldn't it be? Why I don't.
Yeah.
But explain why it wouldn't be viable in your.
Well, let me change hearts and minds for people. So a couple of things. I think one is, if people want to pay basis points, you can already do that, right? There was a custodian who charged basis points. It was called Folio Institutional, and they never reached scale, and advisors didn't choose them, right? So if you wanted that, you could. There's also interactive brokers. You want that? Go for it, right? They'll not take order flow. In fact, Fidelity doesn't take order flow, right? So if people want that, they're welcome to go there. And it's not like it doesn't exist. Now, it's not quite as transparent as the only revenue we'll ever make is the fully disclosed basis points. I mean, some of them will charge you the basis points, and they'll also charge
the order flow.
But I think, there have been some science experiments on this, and it doesn't work very well. But here's the reason why I'm a pretty fervent believer that you don't have to go to basis points. I mean, I think one, if you go that route, advisors will almost unilaterally have to raise their fees. So now you're going to the consumers, you're going to your clients, and you're saying, hey, instead of paying me 1% hypothetically, now you have to pay me 1.2%, because for your custodian, it's going to be another 0.2%. And the advisor's not going to be willing to just take a 20% haircut. They're going to pass that cost forward, right? So now all of a sudden, every single firm is offering wrap fees, a whole nother can of worms there, regulatory wise, which would be a bit of a mess. But now that's what we're all doing, and the prices are going to be exclusively based on basis points. You've removed very much, I think, the ability to serve, I think, clients of all sort of sizes. When you go down that type of route, because The custodians are not going to charge 20 basis points, by the way. They're going to charge 50 or 60 basis points if you try to make them charge you basis points. Their businesses don't work at 20 basis points. Most of them are making over 20 basis points today on just their sweep accounts, right? Their cash accounts. If interest rates go up another 75 to 100 basis points this year, they'll probably make 30 or more basis points on cash. They're not going to pass through 100% of their cash and then turn around and raise your fee 20 basis points, right? Because, we're passing on more return to you. We're just going to, be over here just making our fixed revenue. We're never going to improve our revenue per asset, on our platform. So I think one is it's 100% wishful thinking. It's not going to happen. If it did, the pricing would be so high, it would absolutely crush advisors because all of a sudden now they would have to raise their fees really substantially. In some cases, advisors would have to double their fees, if they're already charging a pretty low rate. So I think functionally, it's just not realistic. I also think that it creates a really difficult, sort of barrier for entry to innovation. What impetus does a custodian have to innovate if the only form of revenue and eventually things like operating margin are controlled by basis points. And what I mean by that is today, if you look at a business like Altruist, we operate on much thinner margins. Our ROCA, our revenue on client assets, is much lower than a lot of other bigger custodians. But we can compete because we can innovate operationally, right? So our costs of doing business, sort of our operating expenses, we can codify solutions that make us way better, a way better fit. We can also vertically integrate solutions, combine custody with software, with model marketplace, right? Like different things that otherwise would be segregated. If the entire world operated the same, right? If every custodian was just 50 basis points, I think it would be it'd be really challenging for any of them to really ever think about innovating. The only real way they could ever increase their profitability would be to lower their costs because all of their top line revenue would be the exact same. And if we go into a world where the only differentiator from custodian to custodian, essentially in terms of their own business economics, is because their gross margins are essentially going to be the same, it's going to be their net operating income. This is a bad world. Nobody wants that world. I want innovation. I want new players to come to space. I want companies to be, willing to take on new firms. If you're charging 50 basis points, do we think the minimums are going to get smaller, to go work with the big custodians? You have $100 million. Why would they ever want you as a customer? Just to be patient and wait for you to get bigger? There's lots of reasons why the current model works. And I think that the real solution is better transparency, but the wholesale switch to basis points or flat fees or something like that. The great irony here, of course, is a lot of this comes from people who they think advisors should just charge flat fees or subscription models, right? Which also doesn't scale. There's not a single company on the planet that's scaling that type of a business model. And all those who try are having a really, really hard time competing against the incumbents that are monstrous, right? That are actually earning their revenue in the form of basis points. So I think it's kind of strange to say we want our custodians to pay basis points, but we want advisors to charge flat fees. Again, these things don't really reconcile in the real world. They might make for good, debate on social media or on conference stages. But they certainly don't help with innovation, launching new firms, creating better access to advice for people who are underserved and don't have significant levels of wealth. All of those things are much better served if we create a sort of free market and we let the custodians choose how they want to earn their revenue and let advisors and their customers choose what's the best fit for them.
That's a good point about bringing innovation into the marketplace for folks who maybe couldn't pay for it if it were just a pure fee environment, right? One of the things that you guys did was you came in at a time when TD Ameritrade was absorbed into Schwab, left a lot of the smaller advisors hanging, not really having a place to go. And there you are with the tools that these advisors need to really launch and start an RIA from scratch without having to scrape and scrounge away at the bigger fish, right?
Yeah, totally. I mean, again, if you look at my own startup story, going back to 2004 and how I couldn't get people to even take my call, here at Altruist, someone can start, they can sign up in the morning, most likely be approved by the afternoon and start opening accounts, even if they have 0 clients right now. There's no cost, there's no contract. Until they hit 100 accounts on our platform, they're not paying a dollar, right? So we are able to create a very innovative, sort of ecosystem or innovation-centric ecosystem where anybody who wants to start a small business as a financial advisor, operating as a fiduciary, that's properly licensed and registered, can totally do that, right? The barrier for entry is much smaller. Consequently, the access to RIAs, sort of the fiduciary channel of advice, can expand faster. And then you combine that with like a bunch of integrated solutions for automation. Those advisors can actually serve more clients. It's very easy to serve 10 times as many clients because you don't have to worry about managing any external integrations, managing external cost structures. Fractional shares allows you to like operate, clients with really any size portfolio, again, at scale. So we don't just want to make it easier for people to start and launch with really no barrier for entry. We want them to be able to serve 10 times or 20 times as many customers. In this way, we can take the number of people that have access to a quality fiduciary financial advisor, and we can 10x, 20x it right across the nation. All of a sudden, you take something that's maybe exclusive for like the top 20 million, high net worth or higher net worth families in the country, and every single person over age 16 years old could have an actual financial advisor. That's what innovation allows. And if we create a world where there's, massive friction against innovation, what we're going to do is we're going to continue to see a world where only the richest people get access to the best advice. The wealth gap between the richest people and the poorest people will continue to expand. These are not things that lead me to be super optimistic about the future. I want a future where, there's more people who have access to great advice that are able to create financial stability for their families, escape sort of generational poverty and instead create generational wealth. Innovation is very important for that. I think we should all be thinking about all the possible ways we can build a financial, advisory future that has a huge amount of, support for innovation, versus getting friction, which is, again, what a lot certain things will lead to friction, which will not lead to, again, the type of innovation that helps people.
Right. So it's be a world where only the rich people get the shiny new object and the nice little innovative platform, and the rest of us are stuck. Take me back to 2004 when you started your RIA. What were you doing before that? You're from Michigan, yeah?
Correct. Yeah. So born and raised in Michigan, and directly before my RIA, I was affiliated with an independent broker dealer for a couple of years. So that's how I learned, sort of the wealth management space.
Well, tell me, to bring it back even a little bit further. How did you go from born and raised in near Grand Rapids? Is that where you're from?
Grand Rapids is a major city compared to where I'm from. I'm from a little tiny town of a population of around 400 or 500 people in rural Western Michigan. And yeah, my journey to financial services was I was a computer science student and fully intended on being an engineer. That was always my back then. This is the late 90s, early 2000s. And in my head, I thought the future was, hey, you get hired at a .com, move to Silicon Valley, IPO, and and that's about as much as you think about when you're that age. As fate would have it, the .com bubble bursts, and those engineering skills were actually better used in finance. So I ended up getting a job at Morgan Stanley at a pretty young age. I was 19 when I got hired, 20 when I started there, and spent a couple of years learning finance, really from a productivity software perspective. But I ended up getting licensed and kind of going through training and really fell in love with this idea of helping people by combining what I knew about building software with financial services, financial advice specifically. That's how I got there.
That's what you were doing at Morgan Stanley, programming and systems. Yes.
Initially, but I actually went through their training program, and eventually, it was a great learning experience. But yeah, I started off like those who like old school Morgan Stanley guys, and gals, they might remember. They used a DOS-based system for keeping track of accounts, and right around that time period, they were switching to a Microsoft Outlook. And in early days of Microsoft Outlook, there were these things called add-ons, and essentially, I wrote programs that would allow you to use Outlook to run scripts against this DOS prompt and look up things like, who are your biggest accounts? What were their holdings? But it's hard for people to imagine, like there was a world, it wasn't that long ago, 22 years ago, where there was no like web-based access to your clients, like the things we complain about sometimes as financial advisors today. were like, those would be like massive improvements over the inefficiencies of the late 90s, early 2000s in wirehouses.
Yeah. And so from Morgan Stanley, you get your first taste of financial services. Where do you make the jump to the RIA track?
Yeah, so I took a couple of years. I actually started like a .com of my own that was designed to automate 401k advice. Was the first sort of venture into how I can help people. The idea, by the way, came from when I was at Morgan. I noticed that the bulk of their efforts were really to serve either, I'd say like affluent to ultra affluent families. Mm-hmm. And, where I'm from, there's not a whole lot of affluent families. My family certainly was not. And I didn't really know anybody who was. And so I thought, well, what if there was a way I could take some of the things I've learned and make them accessible to a lot more people? And I thought about a 401k because in my mind, I was like, well, what do my parents have? Like, well, they have a 401k. They work at a factory. And so what if there was a way that anybody, even if you were blue collar worker and you're just putting 2% of your paycheck into your 401k, that you could still have some form of advice, if you will, or insights to make better choices. But that was the first venture. It was really cool because I learned, how to do front end web development, and I learned a little bit about sales and marketing, and it was a great learning experience. But what I ultimately learned was that trying to get people to self-serve, essentially it was, choose where do you work? Okay. What's your risk tolerance? Okay. Here's what you should do with your 401k. People didn't want to actually do it themselves, is what I found. At that time, they would sign up, they would make some minimal initiative, and then 6-9 months later, they would cancel their subscription and be like, well, if you just would do this for me, I'd pay you twice as much money. And that was a common exit interview, sort of exit survey anyway, response. And I thought, maybe I'm onto something. Maybe the solution is I help these people with their 401ks just directly, and I just charge them a fee. And that's where I started researching, how do you do that? And it led me to the RIA channel, where you could, again, sort of sell your advice for a fee. My first firm was actually focused on retirement because, again, I had this whole 401k platform that I was building, and most of the people I thought would be my age. I thought they'd be people in their 20s or even 30s that were early and just needed a little bit of help. But what I found was the typical customer was a baby boomer, who at that time, these were people in their 40s and 50s. So when I decided to start my first RIA, I called it Retirement Wealth Advisors, and focused on retirement planning. So yeah, that was the journey. It was quite a fun few years.
And you're putting yourself between the sponsor and the employee, helping them, or managing, I guess, their 401k portfolios.
Yeah. So when I actually launched my firm, I went away from managing the 401ks. I mean, of course, we would give advice on 401ks, but implementation was up to the actual client, and just took clients normally. So did full, learned comprehensive financial planning. If they had liquid assets or assets that they were, could either roll over from old 401ks, or they had other advisors that weren't meeting their needs. It was a traditional financial planning led process, and then comprehensive ongoing financial management from that point forward. But again, with a retirement focus, a lot of folks were 50s and above. Okay,
and then you kind of start to get really into the markets, right? What was the idea for formula folios? When did that come about, and what was that?
Yeah, it was a fun transition. What happened was when I started Retirement Wealth, it became fairly successful fairly fast, and I was also still very young, because I was only 24 when I started it, and by the time I was, I think, 27 is when I passed $100 million of AUM, and that was unusual.
Okay, let me just take you back to that real quick. Were most of your clients in Michigan? Were you doing this one-on-one, personal, interacting with clients, or was there some?
Yeah, it's a great question. Initially, they were local, and then I quickly started doing virtual work. So I was like a real OG for working with clients virtually. This is before Zoom and GoToMeeting even existed, and things like that. And so I was using essentially just largely email, and then phone calls, and then eventually a little bit of Skype here and there. But that was the process. But it all started because I started blogging actually in the 2000, I'd say kind of pre-global financial crisis, and then throughout that time period. And And it really helped me attract clients all over the country. And I built a pretty significant base of clients. I ended up hiring a couple of other advisors, and we were so busy with all of the inbound demand from my blogging, which, by the way, I wasn't like writing that often. I wrote like 10 blog posts or something, but they were pretty good, I guess. And there was a whole science behind it, right?
Yeah, not that many people were doing it, right? I mean,
yeah, I think I was, to my knowledge, I was the first. I didn't know anyone before me. I mean, that was doing it to get clients. Right around that era, shortly after me, is I think when like Reform Broker and Jeff Rowe started his blog, Good Financial Sense. So there were some people that kind of came shortly thereather. I think Barry's Big Picture and those kind of all came. But yeah, I mean, at the time I was very, very early, and then used a pretty scientific. I mean, as anyone who's kind of an engineer is going to be pretty pragmatic. So I used a pretty. I wasn't doing it for fun, and to create content. Like I was doing it with a lot of intention, and it worked. So interestingly, what ended up happening was, the growth actually led to a speaking engagement at TD Ameritrade's conference, where they thought they were starting to, have like these little breakout sessions to talk about, online marketing and social media and technology. And so I did a session, and it's kind of funny, that the session, I don't know how many people were there, maybe a couple hundred or whatever it was, but it was a very, very packed room. And I showed people exactly verbatim how I did it, how I was getting all the, inbound demand. Yeah. And I remember like there was an article someone wrote about it. I remember which publication. And there was even somebody that was like, well, yeah, whatever Jason's saying, clearly this doesn't work, because, if it did, he would never tell anybody about it. I'm like, clearly these people don't know me very well. I'm a pretty open book. I'll tell you exactly how I do what I do. But the really cool side effect was I started having a lot of financial advisors start to reach out to me. Hey, I'd love to know could I get plugged in? Is there any way you would sell leads? And as people started looking more at what I was doing, I had a very pragmatic way of onboarding clients. Right? I built my own portal, like way before I had a TAMP. I had my own web portal where we could create proposals and automatically do things like tax location and risk appropriate portfolio proposals. And it just made it really. I tried to really scale onboarding new clients as best as I could at that time. And so people were like, "Gosh, I'd love to use that too. Like, do you license your software?" And it was never meant for anyone other than myself. So the answer was always no. But it got the wheels turning, and in a lot of ways, that's where Formula Folios came from. We essentially repurposed the stuff I was doing. So Formula Folios, a lot of people, the name might imply like it was all about formula-based money management. It was also about formula-based client acquisition. A huge part of our value prop was we did a ton of digital marketing, and we're really good at it, and also like digital hybrid marketing. And the solution basically that I went to market with Formula Folios was, hey, plug in here and we'll show you how to build a digital front end to get new clients. And then you plug into our digital back end to onboard and automate a lot of the back office services. And we'll charge you a fixed basis point fee. It'll kind of our tiered, I guess, fee. It'll go down as your assets go up, and we'll grow together. The story resonated really well, and advisors plugged in and started growing. But the whole business kind of came about really because of advisors and kind of creating inbound requests around how I built that private practice, and it turned out to be what I was doing did scale, and what went from something that was growing really nicely as a private practice, we turned that into one of the fastest growing RIAs in the history of the industry, and still growing very, very quickly to this day.
Are you still sold to Brookstone Capital Management, correct, in 2020?
Yeah, so it was a partial sale and then partial merger. So we had some shareholders that fully sold and moved on, and then folks like myself and a couple of others sold some, but actually merged a lot of our equity into Brookstone. Today, I still own a pretty meaningful. I think I'm the second largest individual shareholder of Brookstone, but they have a great management team led by Dean Zayed and Daryl Ronconi. A lot of my old colleagues. So I don't have any involvement on a day-to-day basis. I haven't for years, but still very much supportive of their business and very proud of what they've continued to do with the company.
And still that itch was there to create something else.
Very much, but also like I realized that I started to feel like the TAMP world might start running into some headwinds. Namely because what I learned is, I as a technologist and someone who ran a pretty large technology organization, our company was 106 employees when I resigned, and about a third of the company were in some type of product engineering or product design. So we although we were offering a lot of traditional services, like a TAMP would, but we were developing a lot of our own proprietary technology. And it wasn't because we just were obsessed with building our own stuff. It was because we were constantly trying to solve for inefficiencies. And so, there was an itch to start a new company, but a lot of it was to, that new company itch oftentimes comes from, I need to solve a problem, right? And the problem that we need to solve was, again, imagine you're opening 50 accounts a day, and the traditional custodian's account opening process resulted in, let's call it a 15% not in good order rate, right? So it means that on any given day, 7 to 8 accounts are going to have something wrong with them. The new account opening process between opening, funding, trading, and your first fee bill run might be a total of, let's say, 60 days, calendar days, which is going to be 42 business days. And so you're going to have at any given time around 300 to 350 accounts in some phase of not in good order, right? Where you're following up on a missed, signature, or somebody whose legal name is, John, but they put Jack as their name on their application. It gets rejected. You got to chase the client down and get, combine that with trading and rebalancing. We were spending 7 figures on external trading software, 7 figures on external software trading. We probably had 7 figures a year in paying people to manage cashiering, right? Once you have 50,000 or more accounts, those accounts have money coming in and out all the time. You have RMDs, you have charitable contributions, you have ACHs coming inbound, you have outbound wires, right? And you've constantly got to manage the cash in those accounts. And there was no automation for that, not from software. Again, we worked with the biggest, most expensive software companies in the industry. They still couldn't codify away those cash management issues. So we had to power it with a bunch of people. Inevitably, between all of the disconnected systems and having so many people working on such large volumes of transactions, you make mistakes, human mistakes. Those mistakes at scale are very expensive, hundreds of thousands, sometimes millions of dollars a year in errors, right? Trade errors, missed distributions, overdraft fees that a client gets hit with, you have to rebate. So I can tell you that, again, as I said before, when you build something and it gets successful, a lot of advisors, they don't understand, and it's okay. I didn't either when I was kind of in my earlier stages, but they accept inefficiency as just like a cost of doing business. Well, yeah, it's a pain in the ass to open new accounts, but I only open 15 of them a year, so it's really not that big of a deal. Yeah, running fee billing is kind of a pain, but I only do it quarterly, and it sucks a couple of days out of the team's lives every quarter, but look, that's just cost of doing business. At scale, all those things, again, they are 100 or 1,000 or 10,000 times worse. So I couldn't help but think to myself, we cannot sit around and wait for the custodians to solve these problems. They have zero motivation to solve these problems. And there was almost like this weird conspiracy-like thing happening, in my view, where I thought, it's really strange to me that the really big firms, at the time, most of them were getting significant soft dollar payments from the custodians to pay the software vendors. So the software vendors didn't really want to rock the boat either, because they might be getting millions or tens of millions in payments directly from the custodian via these soft dollar deals with their largest customers. So no one really wanted to go in and, again, sort of shake up the apple cart, rock the boat, because everybody was just getting fat and happy. Meanwhile, the people who were really suffering were actually the end clients, who were getting maybe inferior advice because an advisor has a limit of how many people they can properly serve before they run into scale challenges, or just people not even getting access to an advisor because the best advisors were no longer taking clients. They didn't have capacity anymore, and they understood the capacity constraint. They didn't want it to yield into bad service, so they just stopped taking. The solution was you have to go to the infrastructure layer of the industry. And you also have to completely shake up the way that the incumbent software companies play with the incumbent custodians. It's an unpopular thing to do, by the way. I don't think we have a lot of friends in software land, and I don't think we have a lot of friends in custodial development. But we have a lot of friends in advisor land, right? The advisors really, I think, love and appreciate what we're doing. but that's kind of how it all came about, right? Like, yeah, was there an itch to start something new? Of course, but it was more an itch to solve a problem that I saw that was going to create a lot of issues for our industry if we didn't get better. Because I think that the fintech companies, look, they'll have their ebbs and flows, but I think over the next 20 years, they're going to keep getting better. And I think a lot of the big companies are going to continue to double and triple and quadruple down on going direct to consumer. And we already see that, like the big custodians that a lot of advisors use, they're building out more and more resources to keep their clients at their branch offices longer, meaning like with larger and larger dollar amounts. It used to be, if they had over $250,000, they'd refer them out to an advisor, or over $500,000, refer them out. Now, oftentimes, if they have a client with under $2 million, let's keep them themselves, right? They don't want to send the advisors the business. And yet here we are, the advisors essentially feeding our competition by using their custody services and using the software companies that are essentially, buddied up with those custodians for lots of obvious reasons, and a lot of people don't want to talk about it. And so, yeah, that's what we're doing. It's an itch, hopefully, that actually results in millions of people having much, much better lives because they get access to great advisors, and those advisors building really successful businesses in new and innovative ways they didn't think was possible before us.
Well, that's fantastic. I had one more quick question. That's a good place to flag in it, I guess. But you've built this software for advisors to grow into, right? An advisor who is maybe new or relatively new to the industry, going to Altruist and growing into what you've built. What about advisors who are coming with multi-custodial relationships and looking for a new solution coming over to Altruist? Is that possible?
Totally. Yeah. I think and I think, the size thing's an interesting part too. The one thing I always will tell advisors, because sometimes they'll say things to me like, well, are you guys sure you're a good fit? Like I work with mostly pretty high net worth clients, and I always will respond, well, most people don't know this, but I still have 11 clients myself. All of those people are what I'd call high net worth at minimum, to some of them ultra or mega high net worth. Altruist is totally capable of that. Like there's no challenges there. They can be multi-custodial. People can be worth $100 million. There's zero issues, right? I know from experience, so it's totally capable. But yeah, what we really tried to do though was kind of start and say, what if somebody only had 10 clients and each one of those clients was just getting started in their own lives and they had $10,000? Like, is this going to be easy and simple and turnkey enough that they can actually come out of the gates and have a profitable business from day one? And the answer is absolutely. Like we have those users. We have hundreds of them joining, almost every quarter, these brand new firms starting from scratch. On the flip side, as firms grow, I mean, again, whether they have 100 million, 500 million, or billions, we have a really interesting kind of eclectic group of users. The advisors that we work with today, we have firms that have over 20 billion in assets, over 10 billion in assets, over 1 billion in assets, like that still use the product, right? So it is very flexible in that respect. And one of the things that's very unique about our solution is that we wanted the software to be agnostic. So although it works, I'd say, it works much better if the accounts are directly with Altruist via Apex Clearing. A lot of the features work fine if the advisor is multi-custodial, because we realize so many people are going to come in and say, I have a lot of my clients, they're already at Charles Schwab and Schwab's been really good to them, and I don't want to move those clients. No problem, right? You can still come to Altruist. Our software will overlay, pull in the data. You can do your fee billing, offer your clients really elegant all-in-one mobile experience. The integrations that we build, you'll be able to take that data. It's totally your data. We don't hold it hostage like a lot of software companies, and you can pipe it wherever you want it to go. So we've really tried to be very friendly, whether you're an existing advisor with a successful business and you're just looking for, maybe a second custodian plus software. We have plenty of users doing that. We have some who make the 100% switch to us, regardless of their size. That's always great. And then we have a lot of people who are starting up new firms, early stage. They probably don't want the complexity of multiple custodians, but they know that they have that possibility without having to leave our software platform, right? They don't have to make that choice. They can actually choose to grow in whichever way is most sensible for them and their clients.
Okay, well, this is fantastic, Jason. We're running out of time. I could keep going forever, but I know I only have you for a small period here. Thanks very much for joining us. I appreciate it. It's been a great conversation. I always learn a lot.
Well, thank you so much. Appreciate the great question asking and sharing of the platform. Very much appreciated the time.
This has been the Advisor Innovations Podcast. I'm David Armstrong. Thanks for listening.
This podcast is sponsored by LPL Financial, a registered investment advisor and member FINRA SIPC. LPL Financial is a separate entity from and not affiliated with wealthmanagement.com.